What's up, YouTube? It's Friday, and you guys already know we back with another Invest in Myself video. Today we'll be velocity banking in the sunflower state, the state of Kansas, with my second client. And when I say velocity banking, you know what that means. We are back on the whiteboard with this episode, and we are going to be paying off debt. So before we even get to the whiteboard, I just want to address a question that I've been getting asked a lot lately. So everybody's got their $1,200 stimulus check, or let me say most people have gotten their $1,200 stimulus check, and they're asking me, hey Charles, should I save this $1,200 for an emergency, or should I use the $1,200 towards a debt? And if you haven't subscribed to the channel, go ahead and hit that subscribe button, that like button. It really does help out the YouTube algorithm, and it helps me reach a wider audience base. And while you're at it, go ahead and click on my first video in the descriptions called Only Dummies Save Money. All right, now that we have that out of the way, let's hit this whiteboard. I haven't been on the whiteboard in quite a while. We will be velocity banking in the sunflower state with my second client. Let's go. All right, so I hope you guys have your pen and pad out, because we will be breaking this down and going over velocity banking to pay off my client's credit card. So my client's alias is Wiley Coyote. Their credit score is a 773, so they have a great, awesome credit score. Income per month is $2,075. Their expenses is $1,400 per month, leaving them with a cash flow of $675. So that would be your income minus your expenses will equal your cash flow. We have that stimulus check that dropped in for $1,200. And Wiley Coyote's like, hey, what should I do? Should I save this stimulus check, this $1,200, or should I pay off my Discover card, which is $5,154 with a 15% interest rate? So what I tell Wiley Coyote to do, I tell this person, we are going to go to the bank and we are going to get a debt weapon. And the debt weapon will be a line of credit. And the amount that they received for the line of credit was $5,000 at a 10% interest rate. So now that we got the figures down, let's go over to the other side and let's break this down with the equation on what you should do and how you should pay off this credit card and even have an emergency fund just in case some things go bad. All right, so let's go ahead and break this down. So we have the equation right here, and I'm going to simplify the equation so we know what we're going to be doing every single month until we pay this credit card all the way off. So let's start with the top equation. So we have our stimulus check. SC, our stimulus check of $1,200. We're going to add that with the line of credit. We're going to add $3,954 out of our $5,000 of our line of credit. We're going to draw this amount out of the $5,000. Adding both of these up, this equals the credit card debt overall. So once we add both of those up, we're going to apply it to our credit card. When we apply all that money to the credit card, it's going to pay it off in full. So now we have no credit card debt. It's fully paid off. Now what this is going to do is going to increase our cash flow by $95. Why? It's because we paid off the credit card in full. So if the cash flow is increased by $95, that means our expenses are decreased by $95, because the credit card is not an expense anymore. We paid it off in full, which is adding an extra $95 back into our pocket because we paid it off instantly with the stimulus check of the $1,200 and the line of credit to pay the difference. The credit card is paid off in full We have increased our cash flow by $95 because we have knocked out this expense, the credit card. Now, since we have used $3,954 out of our line of credit, it leaves our balance at $1,046. Now remember, we're doing this first step May 1st, the beginning of the month, right when that line of credit drops and we get it. This is the first step that we're going to do. So it's literally still May 1st and we've done step 1. So May 1st, we're at a line of credit of $1,046. Now, when the month of May is coming about, the income that my client will get for the month of May will be $3,112.50. Now, I know you guys are looking at the monthly income of $2,075, and that is correct. But my client actually gets an extra check for this current month. So we're adding an extra paycheck. That's why you see the income $3,112.50. But usually on the upcoming months, it will be $2,075. So I do have an asterisk and we will be changing it next month. But to come back, they are going to be getting this amount of money come the month of May. What they are going to be doing is putting their income into the line of credit. They're going to put this $3,112.50 into the line of credit. This makes the line of credit $4,158.50. So we're putting the $3,112.50, and we already have the $1,046 in there. So if we're adding both of those up, this is how we're getting that $4,158 for the line of credit. Now, we have to pay our expenses, correct? So every time we're putting a paycheck in, if we're thinking about like on a bi-weekly basis, every time you put the paycheck, every time you get the paycheck and it goes to your checking account, you put it directly into the line of credit. Now, you're going to use your line of credit to pay your expenses. Now remember, our expenses was $1,400, but since we paid off our credit card, our expenses are only $1,305. So out of all the money that Wile E. Coyote dumped into the line of credit, because it would equal this amount, we need to subtract $1,305 for expenses. So the $4,158.50, we're going to minus expenses from that. Our line of credit at the end of the month will equal $2,853.50 for the line of credit. So the month of May will look exactly like this. Our line of credit, we have $2,853.50 that we can use on our line of credit. Our debt, our credit card is paid off. So we need to think about this here. If we have $2,853.50 in our line of credit, if we ever have an emergency, we can draw out of our line of credit. We do not need 3, 4, 5, 6 months of savings. We have our line of credit. All right, so we're going to move on to the month of June. Now let's look at the equation breakdown chart. So the first 2 steps was only for month 1 because we don't have the stimulus and we don't need to use our line of credit to pay the credit card off. It's already paid off. So we're going to skip to this step right here. So our income for the month of June, she's going to get her regular income, her regular 2 checks for this month. It's going to be the $2,075 of income dropping in for the month of May. She will put all of her income onto the line of credit. So remember, the line of credit is $2,853.50 that ended for the month of May. When you're adding both of these together, we're getting $4,928.50 onto the line of credit. Now remember, we're going to go down to this step here. We have to pay our expenses. So to pay our expenses, we're going to use our line of credit, that $4,928.50, and we're going to pay our expenses of $1,305. If we minus these two, we're going to get $3,623.50 for our line of credit for the end of June. Remember, you have to coordinate this through when your pay frequency of your checks are. So my client gets paid bi-weekly. So the first check will be half of $275. You're going to dump it into your line of credit. Now, if you have expenses within that, you will draw from the line of credit to pay the expenses. Then second check, you will dump it back into the line of credit and pay the expenses from the line of credit. By the end of the month, it should still equal this because your expenses do not change. So don't get confused. You're going to have to do it on maybe a bi-weekly basis if you don't get the full check the whole month. But the concept still stays the same. Every time you get a check, you're going to put it into the line of credit. So your income goes into the line of credit, and then you pay your expenses out of your line of credit. So for the end of June, we are ending at $3,623.50. Now, if you see the trend here, it's always, our line of credit's always going to go up by $770 because that is our cash flow. So from $2853.50, we went up to $3623.50. And next month, it will increase by $770. All right, so we're going to be moving on to the month of July. So starting off for the month of July, our line of credit is going to be $3,623.50. When the income drops in of the $2,075, we're going to put that onto the line of credit. Now, remember, our line of credit is only $5,000, the maximum for the line of credit. So we can't put our whole income into the line of credit. We have paid the line of credit off in full already. So when we do that here, we're going to see that the line of credit will be $5,000. We're going to have $701.50 left in cash, just sitting in your checking account. So we're going to do the next step here. Now, instead of drawing out of the line of credit first, since we have spare cash of $701.50, we are going to apply that towards the expenses. And we see that it does not pay off the whole expenses because it's $1,305 for the month. That means the rest of the money needs to be drawn out of the line of credit second. So once you use all your cash, your leftover cash, then you're going to have to apply some of it towards the line of credit to pay off the rest of the expenses. When we do that, our line of credit will be up to $4,393.50. So we are paying off the line of credit very quickly. And like we see, a reminder, we are always increasing that line of credit, the cash flow, by $770 every single month. So from this month to this month to this month, it's always $770 of cash flow being increased. All right, so let's get to the last month, the month of August. So in the month of August, we're starting off with $4,393.50 on our line of credit. So right here. Now, when the income comes in for the month, $2,075, we're going to dump in as much as we can to pay off the line of credit. So when we do that, it's going to leave us with $1,468.50 of extra cash that's going to be left in our checking account. Now, we're going to go down to this equation. Since we have enough cash in our checking account to pay our expenses, we're just going to use the cash that's left over that we have to pay our expenses. We will actually still have about $150 left over in cash in our checking account. This leaves the line of credit paid in full. So we've paid off our line of credit in only 4 months. Now, some key takeaways to try to simplify this as much as possible. All we did was use the stimulus check and our line of credit to pay off the Discover card that was charging us 15% interest every single month. So once we get rid of the Discover card, it can't charge us interest anymore. Since the minimum balance of the Discover card was $95, and that's what my client was paying, that frees up $95 per month. So we use our line of credit in the stimulus check to pay off the Discover card, which pays it off in full. First, it avoids the interest, and it increases our cash flow by $95, and our expenses, it decreases it by $95. Now, since our cash flow is higher, it went from $675 to $770, we can pay off the line of credit even quicker because we increase our cash flow. Now, to touch on the emergency. Now remember, if we just kept that $1,200 stimulus check in our savings account, that would be our emergency savings. But since we got a line of credit, the first month our emergency savings was $28.53.50. So if something happened, we can just draw off the line of credit. Second month, our emergency increased, our savings increased to $36.23, increased again and increased again. So if you ever have an emergency, you just draw from the line of credit. So it makes no sense to keep that stimulus check in the savings account where it's not doing anything. Pay off the debt, increase the cash flow, and then pay the line of credit back again. Now, another thing that I want to briefly touch. Yes, the line of credit has a 10% interest rate. Now, it is calculated by simple interest, which is different from amortized interest. And I have a video, and I will link it down below, that perfectly talks about how to use the line of credit and how simple interest works when you draw the money out of your line of credit. So please remember, you will pay a little interest on the line of credit, but since you're putting the money back onto the line of credit and building it up, the interest gets less and less. And again, it's only simple interest that's getting applied. I will not thoroughly go through the detail, but please click on the link down below to calculate the simple interest, and you will realize how much you are saving by using the line of credit to pay off the debt and then paying back your line of credit by putting all your income into your line of credit. So Wile E. Coyote, if you are watching this video, like we discussed, we are going to pay off your credit card in 4 months by using the line of credit to pay the Discover card and then repaying the line of credit back. And I hope this really helped you guys. Man, I really do appreciate you guys that do subscribe. So definitely please click that subscribe button if you are not a subscriber. Go ahead and like, go ahead and please comment as well too. It does help me reach a higher audience base. And I really do appreciate any feedback that you can give me, as I will be doing more velocity banking videos. Remember, I am a velocity banking coach. I have my website down below. So if you are looking to be coached on how to do velocity banking, you can go ahead and visit my website and learn about the services that I will be offering. So I appreciate you guys for watching. Like always, I will be back next week with another velocity banking video. You guys, peace out. Have a good weekend. out.